Welcome to the InterMarket Analysis video update. The goal of this video is to be an addendum to the daily videos that I publish every day and the weekly videos, just to look at other areas of the market in a little more in-depth fashion to see how are they performing when compared to the stock market as a whole. This is being prepared for August 29th, 2022. So we'll look at some different charts. Basically, the overall scenario that we're looking at is growth had been really making a nice comeback, but it never did actually turn positive. We had an important meeting last Friday where Fed Chair Powell gave a speech saying that no, we're not going to worry about the economy so much or the growth aspects of the economy until we get inflation under control. And that is considered to be a pretty hawkish stance. So they're going to keep raising interest rates as long as they see fit. Now, earlier in the year, the market had developed this scenario that inflation had topped out and is starting to come back down. And then naturally, the Fed will follow suit by becoming more dovish or market friendly. We got spooked out. Well, the last couple of weeks, we've seen that same scenario as a lot of the economic reports have been showing that even though inflation is still quite high, it has started to come back down. And that was really driving the markets higher. Well, all of that was pretty much taken out on Friday when Fed Chair Powell said, no, we, for the foreseeable future, see that inflation can be a problem. It could bring some pain to folks and to companies, but we're going to keep raising interest rates until we get a handle on the inflation. And the markets didn't really like that because they had been developing a different scenario, and that really pushed things down. So we saw some weakness in this past week. The first thing that we look at is S&P 500 valuation. This just shows where we have the red dashed line. That's the PE ratio of 20. Then we have the PE ratio of 15, which is blue, and a PE ratio of 10, which is green. And this is historically, when we get above the red line, that means the market is expensive. When we get to the blue line, that means it's fairly priced. And when we get down to the green line, that means it's inexpensive or cheap. Well, for many, many years now, the market has been considered expensive, has been falling down, even dropped below the red line for a while, and has since gone back above it. Now, this is TTM, trailing 12 months. These are earnings reports that have been filed, and people can go back and look at those and then say, okay, this is the current valuation of the market. Now, on a day in and day out basis, the stock market doesn't use this. It uses forward-looking PE ratios, and those tend to be a little bit more in hand, but they also go hand in hand with the EPS or earnings per share estimates. Those are based on forecasts and projections, where this is based on more factual information. And you can just see over a period of time on this next chart how the market has performed at times when it's considered expensive, fairly priced, or even cheap or inexpensive. And right now we're still in an even exceeding the expensive ratio. What I've been including the last number of weeks in this video are these things called possible positive scenarios. These are setups and things that we're seeing in the market that could help the market to go higher. Well, after Friday's session, those scenarios are on hold for right now. So I'm not going to address those charts in this particular video, but I do talk about them in the daily videos that I do. So please, if you want to have more of an update, go and watch the daily videos that I post, and we'll be keeping a closer eye on those things. It doesn't mean they've gone away. They're still valid, but they're showing some weakness recently and not really playing into what's happening in the market to help it to go higher. And until things shift around, they're just kind of set off to the side for right now. So, but we do look at growth versus value. Growth stocks, those are the ones that really help the indexes go up. Where value, that's what people tend to get into when the market starts to run into trouble. And I have a number of charts to show you. Here's just a growth index where we had been showing a nice little improvement, but recent weakness, and we're below the 200-day moving average, so we're still in an overall downtrend. We're also in a downtrend with value. It also had been showing some improvement, and came back up to the 200-day moving average, but has since fallen back. Now, it's one thing to study these things independently. What we also do is we look at ratios. This is growth against value, where growth had been trying to make a comeback, but is showing some weakness. And this is the scenario you're going to hear about with a lot of these charts. Recent strength that looked like things were improving, but lately we've been seeing some weakness. The bottom chart is an inverse, showing how value had been starting to underperform, but since has been starting to outperform. Here's another index looking how growth had been really declining, but bouncing back up, almost came up to the 200-day moving average, but has been falling back and is right down to its 50-period moving average. This chart is just an inverse, showing how value had been showing some weakness, but then some recent rebounding. There's another way of looking at growth versus value, where growth had been underperforming, starting to come back up, but now coming back down. And inverse of that same chart, value had been going up, coming down, starting to come back up. And you're going to hear that over and over with these charts. Here's another look showing how growth had been underperforming, but trying to make a comeback, but showing some recent weakness. Some of the other markets, the 30 biggest software companies, they're still in an overall downtrend. They also have been trying to bounce up, but are now starting to fall back. Here's a monthly chart of inflation versus deflation stocks, where it's still suggesting, because we're seeing this in the economic reports, that inflation is still high, but it's coming down. And that's how the market developed this scenario that maybe the Fed can pivot a little bit. And instead of focusing on interest rates and inflation, maybe they'll start to do things that will help the economy grow. That scenario was pretty much wiped out after Friday. Then this is the Baltic Dry Index, and this measures what does it cost to ship goods from one area to another, because when it's more expensive, they have to raise their prices for those products. When it doesn't cost as much to ship those products, then this index tends to come down. We try to use this as an inflationary gauge, and it has been showing some recent weakness as some of the economic reports have been at least coming down a little bit with their inflation. The CRB index is still in an overall uptrend, fell back, but has since been bouncing in a bit of a recovery. Here are some commodities that we look at. Corn is also bouncing back up after having a decline, as is aluminum. Heating oil is still quite high. This is the one that people are probably mostly focused on because gas really spiked up. And this is when you were hearing about it in the news when it was really high. Well, it since has been coming down. And this is the best interest of the politicians in Washington, D.C., to try to make gas prices come down, because everybody feels that. You see that every time you go to fill up your car, and it's the thing that everybody is talking about. So they're trying to do different things to bring down gas prices. Also, natural gas, which is still pretty high. It's spiked up a little higher from where it's at right now, but it's still pretty high overall. Oil, they're trying to get oil to come down under $90 per barrel. Well, right now we're at 93.06. That would also help gas prices. And wheat, after spiking up, fell back down, but has been rebounding. Lumber, still been an overall downtrend overall. So we are seeing those prices continue to come down. The dollar, which has really been doing about the best, it's still in an overall uptrend. It might even be overextended or overbought at this point. And this is mainly comparing it to the other two big currencies in the world, the Japanese yen and the euro. And there's other currencies too, but those are the two main players. But the dollar has been holding up fairly well. Here's the euro, which has been in a decline against the dollar index, which has been advancing. Here's the Japanese yen, which has really been under pressure, with the euro under pressure, and the dollar has been in an overall uptrend. That hasn't really changed much. Copper, another thing that we look at to get a gauge of what's happening in the economy. When copper is really rising, that tends to foresee a positive economic environment. It really started to come down because it was suggesting there might be economic weakness, but lately has been bouncing back up. Here's a copper to gold ratio. where it's showing that copper has really been outperforming gold. And gold is really kind of a mystery right now because in a high inflationary environment with a lot of uncertainty, a lot of headwinds, a lot of crazy things going on right now, that's where a lot of investors like to flock for safety. Well, gold is in a downtrend too. In fact, copper is even outperforming gold currently. And here's a longer term look at that same chart. That's this black chart right here. The green chart is the 2-year yield, and they tend to move in the same direction. And quite often, they don't get very far apart from each other. Even though this ratio has been closing a bit, it's still very, very far apart. And that's leaving a little bit of uncertainty out there because the markets aren't really quite sure what to do right now. And here's the gold ETF. After trying to bounce back up, it has been in an overall downtrend over the last number of days. The same thing with silver. It's really been suffering lately. Looking at some indexes, this is the CRB that we use to measure inflation against the S&P 500. The CRB had been really outperforming, saw some recent weakness, but now the CRB has been recuperating. And here's the inverse of that same chart where the S&P had been underperforming, trying to bounce up, but now showing some weakness. And you're going to see this a lot. NASDAQ 100, which had been making a nice comeback relative to the S&P 500, is now starting to show some relative weakness. Looking at some other stocks, here's the mega stocks. These are the monster big ones, the Apple, the Amazon, Google, all those stocks. They were trying to make a comeback as well, but are showing some weakness. The S&P 100, which is mainly growth, and these are the biggest stocks in the S&P 500, they were trying to make a bit of a comeback, but now are starting to underperform when you compare it to the rest of the S&P 500. Small caps, even though they outperformed on Friday, have pretty much been going sideways overall. Low volatility stocks, which are stocks that folks tend to get into when there are problems. We actually had a recent death cross and we're really starting to fall, but lately have been bouncing back up. And these moving averages may actually produce a golden cross in the not too near future. Here's a ratio between the S&P 500, low volatility stocks, and the SPY, where the low volatility stocks had been doing quite well, fallen back, and now we're starting to show some improvement. Here's the Dow Jones Composite average. This takes the Dow, the transports, and the utilities together. It was able to get above its 200-day moving average, but has fallen back, just like many of the indexes that I'll show you. Here's Dow theory, where we're showing Dow with some recent weakness. The transports and the utilities have been holding up a little bit better, but even they've had some declines recently. This is a longer term look at this same chart. We're usually looking for some kind of divergences, whether positive or negative. And the Dow and the trannies, they've been doing pretty much the same thing. I include the utilities in my analysis, and utilities have been holding up better recently. The FANG stocks, this is Facebook, Amazon, Apple. They've even expanded it. Netflix, Google, and they're going to probably have to spell a new word here one of these days. They've been trying to bounce back up, but have shown some weakness. Here's ARK. A lot of people are in ARK, really struggling in 2022, trying to bounce back up, but has shown some weakness and dropped below the 50-period moving average. It was down 6.42% just in Friday's session. Looking at bonds, it looked like we were forming some kind of a base and then bouncing up out of that. Well, now we're starting to see some weakness in bond prices. This is the World Bond Index, where we went back and tested the COVID lows. We were bouncing up from that. Well, now we're starting to come back into that same area. Stock to bond ratio, monthly chart, even though stocks are struggling, bonds are struggling even more. So stocks still continue to outperform bonds on a relative basis. This just shows how bonds have been underperforming stocks. And I have to cough. I'm sorry about that. I do all of these videos take one, and I don't have editing capabilities right now. So I kind of have to go the good with the bad together. Also, you look at the stock bond correlation, and this is pretty much neutral. What would really help the markets, and I've been bringing this up in a few videos, is if we can get bond prices to go up, which means interest rates would start to come down. that might give some support to stocks and help them go up, because there are times when stocks and bonds go in the same direction, whether they're not going in either direction right now. When we're at 0.25 to minus 2.5, this is what I consider neutral, where there's not really any meaningful signal that's being generated. If this was to go up and the closer it gets to 1, that means stocks and bonds are going in the same direction. When this drops below minus 0.25, that means they're going in opposite directions of each other. Here's the Dow Jones Corporate Bond Index, which also had been showing some improvement, but recent weakness and back up to its 50-period moving average, but still in an overall downtrend based on price. Here's the S&P to the 10-year yield. The S&P had been starting to do better, but now is not doing so good. Junk bonds, which tend to follow the stock market, looked like they were setting up a base coming up out of that, but have shown some recent weakness. Here's a ratio between junk bonds and treasury bonds. Showed that junk bonds were starting to outperform, but have fallen back, even though they're still in an overall uptrend. Both have really struggled, but junk bonds have done a little better. And if you think about it, it makes sense, because junk bonds, they tend to give you, they take on more risk, but they give you a higher yield. And with yields so low with treasuries, people say, man, we're not even beating inflation with the return that we're getting. Why don't we get into a junk bond just to get a better return? But that means that it is riskier. Here are the yields, where for much of June, we saw rates starting to come down, which gave some support to stocks. But in July and into August, we've been seeing how interest rates overall have been going back up. Internationally, showing how the US has been raising interest rates. And this is a weekly chart, with the UK and Germany also raising rates, where Japan's kind of in a different scenario right now. They're battling some issues within their particular economy. And to try to combat that, they're trying to keep interest rates just as low as possible, where the US, UK, and Germany are more fighting the same battles right now. Looking at some sectors, the staples, these are the stocks that tend to hold up better when the market's having trouble. We had dropped down and actually had a death cross, but since we've been above both moving averages, and even though we saw some weakness in Friday's session, we could be getting close to a golden cross in the not so distant future. Energy, which had been going up strongly in 2022, started to fall back. Well, now it's starting to recover. Tech, it was trying to recover, came up to the 200-day moving average and has been falling back. Semiconductors, which is a big part of growth, trying to make some kind of a comeback, but showing recent weakness. Tech against the S&P, when the markets really go up, the S&P, you want to see tech in the lead, and it was starting to do that, but has since fallen back. Some other areas, growth, which has really suffered, and bond prices, which have suffered, just shows that growth has been underperforming bond prices recently. Here's the 10-year yield, which had been going up for most of the year, started to fall back, now showing some strength, even though it came up to its 50-period moving average and has since declined a bit. When you compare it to tech, we're still in an overall uptrend with interest rates. Here's the inverse of that same thing, how tech had been underperforming, trying to bounce back up, but now showing some recent weakness. Discretionary, the things that make life more fun, had been trying to make a comeback when compared to staples, but now we're starting to show some weakness. Then this is the inverse. Staples, things you have been doing quite strong, showing some weakness, but now starting to rebound. Energy against tech. Energy had been doing really well on a relative basis, but starting to really back down. Well, now energy is starting to break out again when compared to the tech sector. Gold, which still seems to mystify most folks as to why it keeps going down, it's been underperforming the S&P 500, and it's been underperforming the US dollar as well. High leverage loans, these are loans that people are willing to get into that are riskier. And when things are going better, people are willing to take on more risk. It had been showing a nice little rebound, but also weakness in the last few days. Here's our InterMarket Analysis chart showing how oil has been performing the best, followed by the dollar. And then you have gold, stocks, and bonds, which are negative going back to the beginning of 2022. Some indexes, and you're going to see the same thing across the board. The S&P 600, which are small caps, they were actually able to get above their 200-day moving average, but then fell back. Same thing with mid caps, where the Dow got above its 200-day moving average, but has since fallen back. The NASDAQ never did get up to its 200-day moving average, but was showing some real strength, but now recent weakness. The same thing with the NASDAQ 100, the 100 biggest stocks in the NASDAQ, and pretty much growth oriented. The Wilshire, a broader base, never did get up to the moving average, but has been showing some weakness. All stocks also trying to bounce back up, but now falling back. Emerging markets never really did do any kind of a breakout, but it looked like they may have been trying to establish a base. Well, we're still waiting for them to break out. China is starting to show some improvement overall, but that doesn't have a real big influence on the US markets, where we're starting to see across the board weakness with the emerging markets. This is rolling over Europe, Japan, and now the S&P in the US. Some correlations, and we're seeing a lot of real strong inverse correlations. So if the dollar is going down, that can help stocks go up. If oil is going down, that could help stocks go up. And the inverse of that is also true. And with the 10-year yield, if yields are going down, that could give some support to stocks going up. Tech sector to the 10-year yield, also pretty strong inverse relationship, as it is with the 2-year yield. So we want to keep an eye on what is the dollar doing, what are interest rates doing. And right now, anyway, if those areas are showing some weakness, that could give some support to stocks. If these areas are going up, that might put more pressure on the S&P 500. So what are our positive areas? Not a lot, but this hasn't changed. Energy is still positive. The CRB index is positive, and interest rates are still going up overall. And our negative list continues to be really strong. With the one that's kind of surprising is gold, because in this crazy environment, you would think gold would perform better. Bitcoin is now dropping below 20,000 again on its index. So we're just seeing a lot of real negativity right now that the market thought we had been starting to get beyond, but it looks like we're kind of back where we were just a few months ago. So thank you. I hope you found this useful. Please feel free to check out the daily videos and the weekly videos to get more insight on different areas within the markets, and I'll prepare this video again next week.